Hello, ladies and gentlemen, and welcome back. Hard landing or soft landing? This is the discussion that everybody is talking about, and it's creating a lot of FOMO in the markets. For many investors, or even traders out there, people are starting to get confused. Today, we try to take a step back and look at the markets with the data that we have available. We'll also talk about extreme zones because depending on what happens over the next couple of trading sessions, we could be looking at a possibility of extreme level 2 areas. What happens here will dictate, no doubt, what goes on in the markets moving forward in 2023. So join us as we cover yields, we cover what the Federal Reserve just said about markets, and more importantly, we take a look at whether we need to be very concerned right now. Well, welcome back everyone to the Daily Show. We've got the news, the macro, the lead indicators, and of course the extreme zones that you'll need to be looking at for many markets out there in the world. It's not to be missed. Let's begin with Fed Chair Powell's comments over the last 24 hours. He said inflation is starting to ease, nothing new there, but interest rates still are likely to rise. The market went down initially and then rallied off that statement. Now, the key thing is that nothing really has changed for Fed Chair Powell. He's really just reiterating, should we really be fighting him? I mean, he's basically saying we will raise interest rates more and it's going to be necessary. Last time, it turns out he knew probably the non-farm payrolls number was coming in hot. He didn't have to say anything. And of course, the market was like, whoa, what's that? Now he's saying again, it looks like, yes, some things are starting to improve, but maybe not everything. Over on our Twitter at FX Evolution, if you're interested in following, we've mapped out effectively what the interest rates are expected to be doing according to the bonds market. Remember, it's key that this is not our opinion, it's the opinion of the bonds traders. And I've often said this on the channel, do I trust the bonds traders more or the stock traders more? The answer is, generally speaking, the bonds traders. And over the last two sessions, they've specifically started ticking up where they believe the terminal cut rate's going to be and how many cuts we're going to get. Notice it is less than it was before because we're having to deal with inflation. So we're getting closer and closer and closer to where we were before all of these rallies started in tech stocks. Does that mean we need to start pausing and being concerned about tech stocks? It means we need to start looking for the signs of a potential turnaround somewhere in the future. So a lot of people will think this thing's just going to the moon. I've seen rocket ships everywhere. Everybody thinks it's 2021 in January and February, funnily enough, the exact same period. And we all know what happened at the end of Feb into March at that zone. We had the traditional rally through Feb, dump in the back end half into March. And that's the data and the statistics that usually goes around with things like the Nasdaq. So are we becoming sell-side liquidity? Effectively, we've got to ask that question. Are we being sold a storyline of a soft landing, yet there's no soft landing to come? Well, again, over on our Twitter, we posted a chart, and many of you will know I love this chart very much. It's the percentage of yield curves inverted. It shows us when the bonds market has all of the different yields inverted. That's the US 2-year, the US 3-month versus the 10-year, all of these different ones inverted. And I like this a lot because it shows us when we realistically have an incredible, overwhelming sense that the recession is coming. And it's never been wrong. So traditionally, it's early, but it's never been wrong. So every single time we've seen these types of incredible inversions, soon afterwards, we tend to get recessionary periods. But one thing that's quite interesting about these is we don't always go into them with incredible inversion. In fact, it's often when we start seeing a drop of the inversion, then all of a sudden, bam, we get the recession. And this is going to be important because it will mean a big difference for trade investors and investors moving forward. If you believe a recession is coming, there could still be lows and opportunities in the future. How are you going to find those lows and opportunities? Well, here's the crux of today's discussion. I want to talk about this forward EPS growth. It's now negative for just the 5th time since 2000. Now, there are some little bits of possibilities that it is still positive, but in general, there are some sources showing us now that the S&P forward EPS year on year has now turned negative. And when this has occurred, what's happened to price action afterwards? Well, it's gone down. Is it instantaneous? No. Is it something that we need to be concerned about? Absolutely. When this has happened in the past, markets have tended to go down after these things have switched. Now, it's always important to say that nothing is 100%, but this is one that I'm certainly looking at. On top of that, we've got huge signs of greed in the corporate bond world. We're seeing US BBB rated corporate bond yields and 90-day US Treasury bill yields having huge switches in terms of where people think the risk is. Now, I've always said I'm not a big fan of trading junk, but it looks like junk is becoming pretty desired in terms of it's not really risk adjusting itself correctly. And you'll notice here that when we've had similar readings, bad things have happened. We're now over a standard deviation away, and we haven't been here realistically since February of 2007 and October, July's of other very large crash periods. So we've got things stacking up together that make us think, well, we've got to be concerned here, or at least thinking about this. What about when the Fed does eventually pivot or finish its rate hiking cycle? Well, at the moment, it seems like terminal rate is at 5.1%. You can see here over at, I think it's Sober Look, if you follow them on Twitter, they've posted this Bloomberg chart where it shows stocks do poorly after the last Fed hike when the curve is inverted. So we know that over 50% of yield curves inverted. In fact, it's more like 80% plus. So it's very likely we go into a recession. There's a big difference. Notice what happens into this point. Median when inverted, okay? When inverted, we tend to have an increase coming into the final rate hikes. Median when yield curve not inverted, we tend to have an increase coming into the final yield hikes. So effectively in both cases, there's a rally. And as we get closer and closer and closer to the terminal rate, that seems to be where the markets diverge, and we get that strong movement forward when the market has not been inverted. And when the market is inverted, we get that declining. And this is, of course, the data back from 1971. So it's basically taking all of them into consideration. We may expect more pronounced versions of this time around due to the fact that there's a lot of algorithms. And of course, there's a huge amount of FOMO and potential trapping going on in these markets. What an interesting switch time, though. Keep it in the back of your mind. Maybe come back to this video in the future and see what you think. Let's move over to investments and trade vestors. What should you be doing? Should you even care about any of this stuff? Well, it depends what you're trying to achieve. As a trader, you don't care. You just want volume, volatility, and movements. As an investor, you do care about price very much. You want to buy the cheapest price, and you want to be able to hold it for a long time. How do you find some of the cheapest prices? Well, you look at the averages. 25-year average is 16.82 forward PE. The market trades 12 to 18 months in the future. You can see that based on the interest rate discussion we're having today. So realistically, if it's under 16.82, it's kind of cheap or fair value. If it's above that, it's expensive. At the moment, it's not really super expensive, but it's not super cheap either. So you've got to say, well, as an investor, should I be in there? It depends on your time horizon. Everything depends on your situation. But you want to be checking these out. And of course, you'll want to be following a channel such as this to get access to that information. Extreme greed versus, of course, extreme fear. Well, with a day like we just saw, we go back into the extreme greed ticker. And you don't use this ever as a certain indicator to say, wow, I've got to sell the market. Use your price action, your technical analysis, your edge to figure those levels out. But certainly we're back in the extreme greed again, and it makes some sense. So how are these markets even rallying right now? Well, part of it was the yields going down. So we saw, of course, yields declining, and that was the forward that allowed markets to go up. The second thing is markets are in general beating the crappy expectations they had. I mean, 67% beat rate, this has increased. We were at 62%, now we're at 67%, and some beat rate and miss articles have it at 70 plus. So it's like a traditional earnings period. It's not even that bad. And that's because expectations were terrible. Beats 568, misses 285. So certainly that's allowed markets to rally because the expectations were much worse than the reality. But what about Q1 of 2023? Will things turn around then? Q1, Q2, we've often speculated are the most important earnings of this year and possibly this entire potential bull or bear market situation that we've got right now. It's probably going to be the deciding factor. Has Wall Street moved into anything that shows us that they're starting to get defensive? Well, one day ago, we mentioned that we had some utilities, we had some staples, we had some of those things doing a little bit better. But now we've basically got utilities, staples, healthcare in the middle of the pack to the lower end of the pack. So we haven't had that 1, 2, 3 combo that we like to see with a grinding market. We'll continue to watch. It was all about semiconductors, realistically, in my opinion, for the day. And it was really, really, really heavy on the AI side. So Google, Nvidia, Microsoft, they were super strong plays. We are clearly in not so much a bubble, because people are going to say it's a bubble of AI, but we are in a parabolic run on those. Now, when that blows off, which it eventually will, because we've seen all this before, we've seen it with lithium, we've seen it with 3D printers back in 2013, we've seen it with weed stocks. It doesn't matter what you've seen it with, it's all the same thing. It eventually will blow off and it will hit extreme highs and most likely then collapse back to fair value. AI is not new. ChatGPT doesn't change the game that much for now. It will in the future, but not for now. So just remember that when you're looking at those stocks going nuts and hyperbolic at the moment, because yes, it's most likely trapping traders in, and you have to be the one that takes the profit before you're left holding the bags. We do have some earnings coming up. We've obviously got Uber, we've got Disney, some big ones here. These are the expected or implied volatility moves. We've also got PayPal coming through, so some big ones there. Do remember, if you're interested in finding out more during this earnings season and even getting involved in our newsletter, we're going to be starting to put out, grab over to the 3 free trading cheat sheets. It's free to sign up anyway, and then we'll send you out that monthly newsletter moving forward. We're also starting a TikTok at the moment, just to give you some shorts if you're interested in watching shorter form content, and obviously Twitter, Discord, and some of our other socials. Let's jump into the charts. Let's look at the VIX. First up, nothing to mention here. VIX was down. Okay, a lot of people believe it's broken during zero-day expiry options. We'll find out about that. But yeah, certainly it was down because the markets ended up going up. Watch the reaction. I've still got 16.37 on there. We'll leave it at that for now. What about yields? Did they move much? Well, we saw that they actually ticked up when it comes to the overall expected cuts. This is interesting. The markets are rallying at the moment like there's nothing to be concerned about. But if we continue to see yields rising with the market rising, that's a super warning sign. Then we look for the defensive rotation. Then we'll know that the markets are starting to set a super trap up. At this stage, US 2-year is hovering at the same highs. And if we go to the terminal rate, which we're still looking at somewhere around September of 2023, it's still sitting at 5.1. That's almost on an all-time high for this current rallying period. So it just shows you how, in some ways, the markets have been very manipulative, because we're back to the extreme terminals. What happens if this goes above 5.25? Well, I think we need to start asking the question of whether this market is rallying on real pretenses or it's completely fake. Let's move over to copper. I often talk about Dr. Copper. We talked about it up here. I've been negative on copper for now. I'm still remaining negative on copper. I don't really like what I'm seeing. The last 24 hours did bounce it up. We've got the long leg doji. We saw a little bounce. I wouldn't be surprised to see that from copper. Obviously, the trend line's really where I want to see testing. We'll get back to this one, but copper often shows us the health of the economy. So we stacked this level incredibly well. Now the question is, does it continue to weaken after Chinese New Year? Watch this space, subscribe to the channel. We'll be following copper heavily. Dollar index, interesting levels hit over the last 24 hours. So the first thing that happened was that the dollar index came up and it ended up hitting into our 61.8 area and a previous, if we have a look here, weekly kind of high zone. So it tapped that area. Then we saw a rejection during Powell's speech, and it came back down and actually filled the little gap that it had here off the Monday open. So we managed to get down there. So now what have we seen? Well, we've seen a high, we've seen a low, we've seen a higher high, and we've got like a lower low here. We've sectorally seen a little bit of a switch with a pullback to an aggressive level. It makes you think that the DXY might be making a move towards this level down here. Now, if it does make a move down to that zone, that would be pretty big because we know that there's a lot of equilibrium at this level. There's a lot of big players that got in. There's a ton of trapped liquidity down here. Poor people that went short down there getting smoked. And we do know that this is going to be the biggest point for the DXY's future strength if it can hold that zone. So at this stage, from the temporary short side, you would have to think it maybe is starting to look a little bit weak. I do believe the dollar index is strong in general during times of interest rates going up because it becomes one of the best vehicles for higher interest rates. And yeah, the switch was interesting. If we look at that just in by itself, you'd have to think, is that kind of precursoring a potential stock market higher move? If this does end up making new lows, so we'll set alerts underneath basically around this price here, which is 102.82, I could see the stock market potentially breaching to a new high and all of it kind of coming through. Be careful here with the DXY. It's going to be a big point. Now, you would think that with the dollar index becoming so strong during the session, gold would have gone a little lower. I was looking for gold to take the lows, bounce back, and that to be a signal that we could move towards our favorite areas up here, which are the 1920 to maybe move back into a short. At this stage, gold continues to hold basically just the trend line. So if you go out, you have a look at the trend line, and you specifically look at something like this, you'll notice it's just sitting right on it. It could be distributing, it could be accumulating. We don't actually have enough evidence yet to make a full decision. It did breach the top side and then weaken. So I guess you would be going with gold short, but of course the DXY is the key. I'm going to go with neutral at this level for now. Natural gas bounced, actually found a little bounce. Is it the bottom? Is the bottom in? A lot of people messaging me about natural gas. Everyone's talking about it now. Yeah, you don't know that yet. It bounced, sure, it went up like 10%. It's nothing for natural gas. It can go up. It went down like 80% in only a few weeks. So it moves pretty quickly. We trapped these levels. We took stop losses. We've most likely hunted those now, and we're basically looking for accumulation. Be careful on natural gas. It's one that we'll watch and we'll come back to in the future. Now let's move over to the elephant in the room. And I know a lot of people in the chat are kind of mad at me about this one. And I don't blame you in some ways. Like, you know, obviously my targeting was probably more like the 150, 155s due to options. We then had the next level, which was the extreme level of where we are right now. So we went from 150, 155 to the next extreme level being right here. And I'll say this, it's a very important zone for a lot of stocks. Tesla, firstly, has several high zones and a lot of FOMO and 200 calls that are all floating around this level. If the stock market is able to breach to a new high and close, I think we have to explore the possibility that Tesla could move to these next extreme zones, which I have up here. And that's a pretty significant move. It's another $20, $30 on the stock. So do remember, extremes can be hit. It's hard to pick tops. I posted this over on Twitter, but these levels I still think are incredibly critical. And the next 24 hours or even 48 hours in stock markets may tell us a lot about whether the bears really are in control or they're about to lose it and the markets are going to move to an extremely aggressive position, which could push us to 4,300 plus to 4,350 on the S&P 500. These zones are going to absolutely make people lose their minds for sure. Let's move over to Tesla's options over the last little bit. We've still got a lot of 200s. You can see here the flow into the calls is starting to happen. This is retail traders getting hyped. I don't blame them. They're excited about, you know, the idea of 90%, 100% returns, but this is still a time to be incredibly cautious. In my opinion, two profit target levels have been hit, that 150, 155 on the calls, and of course this really good extreme technical high. And it's why you're better off using technical highs and calls together than just call walls, because call walls will limit you a little bit. It's only one bit of information. You want to build a stronger case scenario. And we are at a very strong level for this week. If it does bust through though, could we be in for a big squeeze? That's the next question. And of course, stocks will show us it, and we'll see it on things like the S&P 500. Let's look over at another retail favorite. It's Apple. And we know that it's now filled the gap. So that's not too bad. Apple filled the gap. Nice. We don't have a reaction up here yet. We know that markets rallied after the Fed comments, and the Fed comment sent it down, then rallied it. So we find ourselves in nowhere land really on Apple. Very tough market to trade. Amazon hit these expected weekly options low and bounced off that zone. So fairly nice from Amazon. It was very weak after that island reversal where we got the gap up and we got the gap down. It was probably our premier short, and it continues to be at a tough point. Where buyers may recommence could also be down here in the 92 area, but I could see why this level was wiped, and of course it was on our expected weekly options lows. So yeah, a pretty good level for day traders if you were looking at it to the long side. But I think the biggest interest at the moment has to be on AI. So many AI stocks are breaking out. I think that they're at still very concerning levels, but my favorite, Microsoft, I mean, I'm only buy side on Microsoft. I don't even know what a sell is on Microsoft. Is moving up, and it closed above those highs. And this goes for all of the AI plays. Look at Google, big recovery here on Google. Let's go over to NVIDIA, another strong closure for NVIDIA. I've got this 227 set. So almost all of the big AI plays or AI plays are running kind of like not so much a bubble, because people will call it a bubble, and that usually means it doesn't crash, but certainly they're running on hype of this new so-called new AI. It's not new. We've already known about it. It's just the resurgence of an idea. And that's how you get trapped when you think, oh, lithium's the next big thing. How far are you into that rally? You've always got a question. You always think you're going to be able to get out early. How many times in the past have you been able to get out without being left holding the bags? So you've got to decide, are you willing to take those risks? XLY versus XLP, this shows us consumer discretionary versus staples, or the American consumer. Continues to be relatively strong. We haven't seen a defensive move by the markets properly yet. We will continue to watch. If we see it, it could be a very good precursor to things actually starting to turn around. Chinese market remains at these high periods, which are still where shorters should be sitting. We'll find out what goes on there. And from the UK or the European markets, we're still quite bullish in terms of the price action. We have to get underneath. We said watch reaction here at 7706. We'll continue to watch it. Move over now to the US indices. Let's do that together. We've got the symmetrical triangle, still not broken through on the Dow, but damn close. So we'll be watching that one over the next 24 hours. We'll be watching the Qs. Of course, we've got the expected weekly options high getting closer. We also have potential reaction zones, retracement zones, all sorts of things going on in the Qs. A critical level for sure. If it breaches through, where's the next level for it? Somewhere up here in the 330s. So very, very critical times here for markets. And at this stage, we just have to kind of wait and see. What about the Nasdaq? Well, it built a pretty decent base. You can see here the Fed comment and what happened. It went bang, shooting down. It actually initially rallied and then shot down. That's actually a pretty usual signal towards going short. It wasn't able to bust the lows. We'll see on the S&P 500, it did just take the lows, but this is a super level now, isn't it? This 12,420 area, or in general. If it does go back under there, our trend line could be reached, and then that could actually tell us whether the bulls are really committed to this trade as we see weakness. This is still a very critical bear zone. This was a great short over here. Fantastic short over here. We're back testing that. Generally, markets will, if they're about to tip over, they'll coil or create distribution. And markets tend to end one of three ways. One of the ways that they end is distribution. So if that continues to play out like that, we see a defensive move, then it will be like similar distributions that we've had in the past. One notable one would have been the one in here, where we saw a distribution above the highs, and then of course we got absolutely destroyed a few days after that distribution. So watch this space. We will be very cleanly. We mentioned at the start of the video, we've got extreme zones. Well, the gap that we hoped would be closed has now happened, so we can delete that off our charts. We now see the extreme zones. We've filled a lot of the gaps that were there. Will we make a new high and then instantly reject it? Something that is possible. The closure above here will be very significant in my opinion. If that does occur, we could be moving towards extreme zone 2, which pushes us to a 4,300 to even 43.50 narrative. So this is what's at stake, an extreme zone, extreme levels, and something that we'll have to pay attention to both of these zones. Bears have a very strong case here. They've also got an extremely strong case up here. The bulls lose their cases as you get closer to these areas. What's the risk versus reward? We've had a massive rally. Eventually, you will get a decline. The question is, which one of these? And if it isn't one of those, well, I'll admit I'll be the first up to say my extreme zones didn't work, but I've done a bit of work on them. I feel like they're pretty good. Let's move over to the S&P or the SPY here. Expected weekly options high was reached. So we've hit that kind of high level, and we didn't really reject it heavily. Small time frames did. We initially saw that sell-off. You can see here again, it was a pretty nasty trap because it sold off. People would have put stop losses above here, and then it came and took them straight after that. I haven't seen that one for quite some time. Here we get, again, the low being formed. You could make a case that this is a bullish signal and that wiped people, and that lots of people were short and got wiped here, creating liquidity for Wall Street. I'm actually willing to just say wait and see on this 24 hours. This is a very critical area, and I'd still probably be leaning the bear side up here just due to risk reward. But if this thing busts and makes a new high and closes, then I still think there's more potential on the upside to happen. Let's move over to US 500 futures, and I want to use this one here. This is again an area that we've stacked before. One of the ways we stacked it was obviously using fixed range volume profiles and realizing that this was a heavily traded zone, the most heavily traded zone through the drop. So effectively, there's a lot of volume that could come in here, and that's partly the reason that we get the 43.50. There's a few other reasons, but it's really probably the last stand for the bears in this huge bull rally, at least from a technical perspective of what we can see with the evidence right now. Let's refresh the S&P 500 futures, or the options, and we'll get the 10th here. And you'll notice we still have 4 10s, 4 15s, and 4 100s. Not much changes here to the options. We're still stuck between two pretty large strikes. There's nowhere near the amount of calls or puts that we saw in recent weeks. On the 17th, we still have a huge amount of puts, so it's very unlikely we're able to crash too much. And if we go through to March and we have a look at the 17th and I think it's the 17th of March, we end up getting still a lot of puts. The puts are still getting stacked, and it's really annoying. Like, what is this for 100,000 units at 400? Like, these are the types of problems that you have with creating markets that can come down. When everybody goes negative, of course, markets tend to rally through. We still have some calls coming in, but yeah, I don't like those 400 puts. I wish they'd bugger off and calls would come in higher if you're wanting the bear market to resume, if that's what you want to see. Let's have a look at Bitcoin. No news here. Absolutely nothing going on with Bitcoin. Pretty boring market, actually. Still dull. No new low. Still set alert here. That's about all we've got at this stage. News for the week ahead. There's not too much amazing news coming out. We do have Wednesday some stuff. Let's just quickly scroll down here to the next week. Make sure we get that up. And we know that we have the FOMC member Williams speaking here, and that's at 9:15 a.m. New York time. Then we scroll down and we get prelim UOM consumer sentiment at 10 a.m. New York on Friday. There's some earnings. There's that stuff. There's not that much else coming out. Remember to follow us on the other socials if you're interested in some of the content we push out, and subscribe here on YouTube. Thanks so much for watching. Thanks for supporting the channel, and we hope you found some value in today's video. Bye for now, guys.